Let's talk about one of the biggest, most expensive paradoxes in all of finance. Why so many of us, even when we know we shouldn't, end up waiting to invest, and almost always invest too late. We're going to break down the psychology, the weird way the market works, and the history behind this really frustrating pattern. You know the feeling. Just think back to any market panic. The news is just a waterfall of terrible headlines. The charts are all bleeding red. And pretty much everyone, your neighbor, the experts on TV, they're all saying the same very sensible sounding thing. It feels so right, doesn't it? It feels prudent. You know, just step to the side, move your money into the safety of cash, and just wait. Wait for things to calm down. Wait for some clarity. It's the advice we give, and it's definitely the advice we take. But here's the question. What if that feeling of safety is just a total illusion? What if the very act of waiting for that dust to settle actually guarantees that you miss the most important part of the entire recovery? That's the core puzzle we are going to unpack right now. Okay, first things first, let's dig into why waiting feels so good. So right. This isn't a character flaw, and it's not a sign that you're a bad investor. It's a deeply, deeply ingrained human instinct. And to really get it, we have to look at how our brains are wired. See, our brains are basically running on ancient software. They evolved over thousands of years to handle immediate physical threats. You know, like a lion in the bushes, not a percentage drop on a computer screen. The instincts that kept our ancestors alive on the savannah are the very same ones that lead us completely astray in the stock market. So let's get really specific. What is actually happening inside our heads during a market crash that makes us just freeze up? It really all comes down to a few key psychological triggers. Okay, this is a really, really important distinction. We tend to use the words risk and uncertainty like they're the same thing, but to our brains, they are worlds apart. Risk is when you know the odds, even if those odds are bad. Uncertainty, or ambiguity, that's when you have no clue what the odds are, and our brains absolutely hate that. Think of it like this. A roulette wheel is a known risk. You can calculate the exact odds of hitting red. It's math. A market crash, though, that is pure ambiguity. What's the probability that the entire financial system collapses? Who knows? We have no idea. And when our brain is faced with that total unknown, it doesn't calculate. It just freezes. It leads to paralysis. And here's what that paralysis looks like in the real world. Our brain just defaults to survival mode. It immediately fixates on the absolute worst-case scenario. I'm talking global depression, the end of the world, and it completely ignores any possibility of a recovery. The amygdala, that's our brain's little alarm system, it just takes over. And in the world of investing, flight doesn't mean running from a predator, it means running to cash. Why? Because the number on the screen isn't bouncing around. It feels safe, even if inflation is silently eating away at its value. Okay, so we've established that our brains are basically backward-looking survival machines. Well, the market is the exact opposite. And this is where the huge disconnect happens. We really need to understand how the market actually thinks, because it's completely counterintuitive. I absolutely love this quote because it just nails it. The stock market isn't a thermometer telling you how sick the economy is today. It's a thermostat. It's a collective betting machine that is constantly trying to guess and set the price for what the world is going to look like 6, 9, even 12 months from now. Now, this might sound a little like high school calculus, but stick with me, because it's probably the single most important idea for understanding how markets bottom out. So think of it in 3 steps. Step 1, the economy is bad. Okay. Step 2, things start getting worse, and they're getting worse at a faster rate. But the market turns at step 3 the moment things just start getting less bad. It doesn't need good news. It just needs the rate of decline to slow down. That subtle shift, the change in the rate of change, that's where the recovery actually begins. And this just puts it perfectly. During a full-blown panic, the market prices in the absolute worst-case scenario. It prices in the apocalypse. So the second the data comes out and it's merely horrific instead of apocalyptic, the market rallies. While you're still looking at all the wreckage from the storm, the market is already celebrating that the damage wasn't infinite. And look, this isn't just some abstract theory. This exact pattern has played out with brutal, brutal consistency at every single major market bottom in modern history. The evidence is overwhelming, and yet it seems to be a lesson that we all have to learn over and over again. So let's take a look. Case study 1. The Great Financial Crisis. Look at these dates. The market hit its absolute generational bottom on March 9, 2009. But the worst of the economic pain, measured by unemployment, that didn't even hit until October, a full 7 months later. And this is the most crucial part. On the very day, the literal day, that the market bottomed out, the prevailing sentiment was the most negative it could possibly be. The most respected financial newspaper in the world was asking, how much lower can we possibly go? There was zero clarity. This was peak fear. So what was the actual price of waiting for that clarity? 64%. That is the gain you missed out on if you waited just 9 months for the economic data to finally confirm that, yeah, a recovery had started. By the time the dust settled, the biggest, easiest gains were long gone. Now, if you thought 2009 was fast, 2020 was an absolute masterclass in just how forward-looking the market is. The market bottomed out in late March, right when the entire world was literally shutting down and ambiguity was at an all-time high. It then went on to hit a brand new all-time high in August, months before we got the so-called good news. The cost of waiting for the clarity of that vaccine announcement, a mind-boggling 50 to 60% rally. The market didn't wait for the cure to be announced. It priced in the eventual cure the second it saw that governments and central banks were going to throw everything they had at the problem. It was betting on human ingenuity. So if our natural instincts are going to fail us every single time, we need new instincts. Or maybe better mental models, better analogies that can help us reframe what's actually happening so we can act more rationally when every part of our brain is screaming, "Get out." This is probably my favorite analogy for this whole concept. Investing during a crash is like buying a fixer-upper house. It looks ugly, the neighborhood feels sketchy, the whole thing feels really risky. But that's precisely why it's so cheap. Now, waiting for clarity, for the economy to feel good again, that's like waiting for that same house to be fully renovated in a beautiful, established neighborhood. Sure, it feels safe and comfortable, but now it costs more than double. That $300,000 difference, that's the price you pay for certainty. You cannot have the cheap price and the feeling of safety at the same time. They don't coexist. And here are just a few other quick ways to think about it. Don't confuse today's weather with the overall season. A bad thunderstorm, a scary headline, doesn't mean that spring has been canceled. And think about a traffic jam. Hopping over to the lane that just started moving is usually a mistake, right? By the time you get there, it stops. And it's the same with the supermarket checkout line. By the time you spot the fast line, it's already crowded and slow. Sticking to your original plan is almost always the best bet. All right, let's bring this all home and just look at the cold, hard numbers. Because the cost of waiting, the price of seeking clarity, it isn't just a missed opportunity. It is mathematically devastating to your long-term wealth. Just look at this. The math of trying to time the market is absolutely brutal. Over a 30-year period, if you just stayed invested, you got around a 10% return per year. But if you jumped out and you missed just the 10 best days, your return was cut in half. Missed the 20 best days, and you've lost 70% of your potential wealth. And here's the cruel joke. Those best days, those huge up days, almost always happen right next to the absolute worst days. So if you sell in a panic, you are practically guaranteeing you will miss the explosive recovery. So this is what it all boils down to. There's no free lunch here. You have a choice. You can either pay the emotional price of uncertainty. That means feeling scared and uncomfortable during a downturn in order to capture those higher potential returns. Or you can pay the very real, very high financial price of waiting for certainty. And in doing so, you accept much, much lower returns. You have to pay one of them. The only question is, which price are you choosing to pay?